Welcome to The Explainer. Today we are diving deep into one of the most powerful, time-tested strategies for building wealth, dividend investing. We're not just talking about picking stocks here. We're talking about building a portfolio that's designed to do one thing really, really well: generate a real, tangible cash income stream that grows over time. So let's just start with a really simple but kind of profound question. What if your investments didn't just sit there, hopefully going up in value? What if they actually paid you in cold, hard cash just for the privilege of being an owner? Imagine getting an alert from your bank account every 3 months, not because you sold something, but because a company you own a piece of is sharing its profits directly with you. Well, that's not some fantasy. That's exactly what dividend investing is all about. All right, here's our game plan for today. We'll start with the most important part, the ownership mindset. Then we'll get into the nuts and bolts of the power of dividends. After that, we'll help you pick your strategy because there's more than one way to do this. Crucially, we'll cover avoiding the dividend trap, and we'll wrap it all up with why this is truly a long-term marathon. Okay, first things first. Before we even touch on a single number, a stock, or a strategy, we have to get our heads in the right space. This is the foundation for everything that follows, because adopting this mindset completely changes how you look at the stock market. See, at its core, dividend investing isn't about buying little blips on a screen that you hope to sell to someone else for a higher price. No, it's about becoming a part owner of a real, living, breathing business. You're not just a speculator, you're a shareholder, a partner. And as a partner, you're entitled to your share of the profits that business generates. That mental shift, right there, is the difference between short-term gambling and long-term wealth building. And this is where it really differs from what you hear about most of the time: growth investing. You can think of a growth stock like a young sapling. You buy it, and the company pours every bit of sun and water, every dollar of profit back into growing as tall and as fast as it can. Your entire reward comes when you eventually sell that big tree. Dividend investing, on the other hand, is like buying a mature apple orchard. It might still grow a bit taller, for sure, but its main job is to produce a steady, reliable crop of apples, cash, for you, the owner, year after year. Your total return is that beautiful blend of the orchard's value increasing and all the apples it gives you along the way. Okay, so we've got the mindset. Now, let's look at how this simple idea of getting paid a little cash transforms into a seriously powerful engine for creating wealth. Because believe me, those small payments are just the beginning of the story. So why is this so powerful? Well, a few big reasons. First, the obvious one. You're building a passive income stream, money that shows up without you having to sell a single share. Second, a consistent dividend is like a company's report card. It's a loud and clear signal that they are financially healthy and disciplined. You can't fake cash flow. When the market inevitably panics and prices fall, those dividend checks provide a real cash cushion. It's money you can use to live on or, even better, reinvest and buy more shares on sale. Over the years, as great companies raise their dividends, that income helps you beat inflation. And you know, the last point might be the most important: the psychological boost. Getting paid to wait helps you stay calm and patient when everyone else is freaking out. This brings us to a super important concept: total return. So many people just fixate on the stock price, but that's only half the picture. Let's say your stock price went up by 5% this year. Pretty good, right? But what if it also paid you a 3% dividend yield in cash? Your total return wasn't 5%, it was 8%. Ignoring dividends is literally leaving a huge chunk of your potential earnings on the table. You have to look at both growth and income. Now, if there's one idea that shows the true long-term magic of this strategy, it's this one: yield on cost. It sounds a little technical, but the idea is simple. Regular dividend yield is based on today's stock price, but yield on cost, well, that's your own personal yield, based on the price you originally paid. And watching this number grow over the years, that's where things get really exciting. Let's watch this snowball roll downhill. Imagine you buy a stock for $50. It pays a dividend of $1.50. Simple math, that's a 3% yield. Not bad. But this is a healthy company, so it raises its dividend by about 8% a year. By year 5, your initial $50 share isn't paying you $1.50 anymore, it's paying you $2.20. So your personal yield on cost has grown to 4.4%. Now, let's fast forward to year 10. That dividend is now up to $3.24. And your yield on cost, it's now a whopping 6.48%. You've more than doubled the income stream from your original investment just by picking a good company and having the patience to hold on. That's the compounding machine in action. Okay, so you can see the potential here. The next logical question is, all right, I'm sold. How do I actually do it? Well, it's not a one-size-fits-all deal. You've got options, and it really comes down to choosing the path that best fits your own financial goals and timeline. You can basically think of it as two main camps. In one corner, you have high-yield investing. This is for people who want the most income they can get right now. Maybe you're in or nearing retirement. The focus is purely on that big, juicy current yield, but it comes with higher risk. In the other corner, you have dividend growth investing. This is the strategy we saw in our snowball example. The goal here isn't today's income. It's about building a much, much bigger income stream for the future. You accept a lower starting yield in exchange for the reliability and growth that can create serious wealth down the road. And within that dividend growth camp, there's a VIP section. It's known as the dividend aristocrats. These are the titans of industry, the blue chip legends in the S&P 500 that have not just paid, but increased their dividend for at least 25 straight years. We're talking through recessions, wars, tech bubbles, you name it. They've built economic moats, unbeatable brands, and competitive advantages that allow them to be incredibly consistent year after year. Okay, we need to pause here for a really important public service announcement. Before you get too excited and run off to find the stock with a 10 or 15% dividend yield, we have to talk about the single biggest mistake that new dividend investors make. It's absolutely critical you understand this. Here it is. If a dividend yield looks too good to be true, it almost always is. This is the infamous dividend trap. Remember how yield is calculated? It's the dividend divided by the stock price. So if a company is in deep trouble and its stock price is tanking, the math will make the yield look huge. It's a siren song, luring you in with the promise of a big payout. But that high yield is actually a giant red flag, screaming that the market thinks the company is about to slash that dividend to zero. So how do you avoid stepping into that trap? You have to become a financial detective. You have to look under the hood. This checklist is your toolkit. First, check the payout ratio. Is the company paying out way too much of its profits? Anything under 60% is a good sign. Even better, look at free cash flow. Dividends are paid with cash, not accounting magic. Does the company actually generate enough cash? You'll also want to look at its debt. Is it drowning in debt? And finally, look at the dividend's history. Has the growth been consistent, or is it starting to slow down? That could be an early warning sign. All right, we've gone through the mindset, the mechanics, the strategies, and the traps. Let's zoom all the way out now and put everything together with the single most important idea you need to remember. Let me be crystal clear, this is not a get-rich-quick scheme. If you're looking for a stock tip that's going to triple by next month, this isn't for you. This is a get-rich-slowly but surely plan. It's a marathon. It's about finding wonderful businesses and having the discipline and patience to hold them for years, even decades, letting that beautiful compounding machine do its work. It's all about that ownership mindset we started with. And that brings us to the final thought I want to leave you with. This isn't just about spreadsheets and stock charts. It's about what this strategy can actually do for your life. So the real question isn't about payout ratios or yield on cost. The real question is, what could a steady, reliable, and growing stream of income mean for you? Could it mean retiring 5 years earlier? Could it mean paying for your kids' college education? Could it just mean sleeping a little better at night? Once you understand the framework, you can start to imagine the future it could help you build.